doing here with us. We have a special guest today. We're talking all things stocks. We can talk individual stocks. We can talk active stock investing. We can talk about the index itself. We can talk just investing, asset allocation. He knows all these things. My very special guest today from the Buzz Index, Mr. Jamie Wise. Jamie.
Hey, Joe, how are you? Nice to be here. Finally, technology issues resolved. We're ready to roll.
I can't believe we actually got this sorted out. What's up with that?
It's probably because I'm in Canada.
Probably.
There's got to be a Blame Canada gif somewhere, right?
No, the interface between Canada, American, like the exchange rate and technology, it kind of doesn't fit right.
Worlds colliding.
But we got everybody here. We've got you here. So I want to talk about some of the buzz you've been hearing while we're waiting for questions. By the way, if you've got a question for Jamie or just about your financial planning, whatever it might be, put those in the comments and we'll take those. But let's talk about some of the buzz that you've heard lately, because I know that my buzz newsletter from you, I've gotten a few lately. Tell me what's been going on with the Buzz Index. Well,
we did the October rebalance, I guess about 10 days ago. The most notable name we saw come in, first time ever, Snap. I almost shook my head when I saw it because
I saw that.
Right? We always saw negative sentiment around that name from the day of the IPO straight through that first pop in the stock. And even as that stock rolled over and traded down to I guess around 12 or 13, sentiment was sort of consistently negative. And then in late August, it just sort of flatlined. And then the stock started going sideways. And then slowly but surely, I think as the stock found its footing or some kind of floor, sentiment started picking up. And I don't know in so much, there's just so much conversation on Snap and on that company online. Is it a function of really the company's prospects turning around, or is it a trading play that it just fell too far too fast and it's due for a, pardon the pun, snapback? I know I shouldn't have done that. But collectively, people started really responding to the stock, the fact that it stopped going down, and I think they see it as a short-term play. So we're going to come up to earnings next week. It's going to be a really exciting one to watch. We've seen this happen in the Buzz Index before, where online and the broader consensus sort of leads the stock, and this is a real good chance that it's another story. So we're expecting good things.
And it's weird because all you hear about all the time is that Snap, like Ray says here. Ray, we'll get to your question in a minute. I bought and sold Snap, thought it was a sinking ship. You look at with Instagram, Facebook really stepping into that space. I thought Snap was getting buried. Apparently, people online think something different.
Yeah, well, I think people bought into that story early on. That was certainly the consensus view. And I think Ray probably had a great trade, right? It was a sinking ship. It went from 25 to 12 really, really quickly. But the stock is stable now. And there's no doubt that expectations, at least in the media community, in the traditional media community, when you see an analyst on TV, when you see the TV personalities talking about the stock, probably because it's had such a horrible time and it's had all this competition from Facebook, I think they've tried to set this tone of it's over for the company. They don't have a chance against Facebook. But I think, people are starting to see through that a little and say maybe there's, so much negative sentiment just from those loud voices in our community. Expectations might be geared too low, and this thing can actually turn around and surprise some people to the upside. Well, you have to believe they're going to fight for their lives here. We'll see what they do in the quarter.
Yeah, right. And there's those stories, right, where he could have sold the company before, but played for bigger. And now I wonder if they're wondering if they should have sold it with Facebook trying to eat their lunch. I've got a question. So Snap is one that surprised Ray and surprises other people on coming into the index. What left the index in October, Jamie?
Well, we lost a whole bunch of airlines, and that really has been timely, especially as we've seen this rally in oil. Maybe people saw that coming, or maybe they just realized that some of these airlines had a big run and it was time to take some money off the table. The biggest name that we'd all be familiar with that really has been in the index probably more often than not that's come out now is Disney. And a lot of challenges with Disney. A lot of moving parts there with the ESPN network, with their own content, with theme parks, with issues around hurricanes and all of those other things affecting the business.
Yeah, I'm thinking also the loss of the Netflix deal.
That's exactly right. Yeah, there's another one, right? So I think slowly but surely things have been chipping away at that story. What a fantastic run the stock has had. I think people just overall said it's time to take some money off the table and look elsewhere, and out it went.
You might not know this off the top of your head, but how long did you guys own Disney?
Oh, I don't know it off the top of my head. I would guess since we launched the BUZ ETF back in April 2016, I would say it's probably been in there 60 to 70% of the time.
Yeah. And the airline thing doesn't surprise me as I look at gas prices. That seems to make perfect sense why people would say, you know what, it's going to be harder for them to make a buck.
Yeah, absolutely right. And what a rally we've had in oil here. So I think that's going to play out for some time now.
So does that mean that in the future, you think you might see some of the oil companies coming back in and online? I would imagine, and I haven't looked at stats on this, but I would imagine that around Houston being hit by the hurricanes and stuff, that we might have had some disruption there also. So,
well, funny enough, we did have one oil name come back into the index last month, and that's Kinder Morgan, right? And we've seen this name before. It's a very actively traded name. It's a really actively discussed name. There's a lot of beta to it. So, to some listeners that might not be familiar with that term, it sort of tends to move a little bit more than the market, right? So if oil's price is going up, if the markets are doing well, Kinder Morgan will probably do even better than the market. But it's got that beta to the upside and to the downside, and that's why traders like it. But certainly with the move in oil, people, I guess, are getting again more positive on that story, really actively traded. Back it comes. And I'd say that's a name that's been in our index 20% of the time. Came back in around 5, I believe. So we'll see. We'll see how it does.
Guys, we got Jamie Wise from the Buzz Index is with us. It trades under ticker symbol BUZ. The interesting thing about the Buzz Index from where I sit is somebody's calling me on Skype. I'm in the middle of this thing and I get this big alert right in the middle of my screen. Whoever's calling me on Skype, you gotta wait. That's weird. I never get calls on Skype, but of course when we're live, I do. I even forget what I was going to ask you. That completely shocked me. But if you've got a question for Jamie about either the Buzz Index, about your own stuff, about any individual stocks that you own, maybe things that he's seen with the Buzz Index about those positions, active versus passive investing, whatever it might be, bring those on. I have the question from Ray now. Let's bring that up. He says, what do you think of TD Ameritrade getting rid of Vanguard? You see this, Jamie? He lost 2 of his positions. I kind of think I know why this happened, but do you have any insight for us?
I don't actually. And you know what? Maybe being up here in Canada, we have a different version of TD, even though it started Toronto Dominion Bank. So I actually didn't see that news. Joe, I'd like to hear your take.
Well, here's the deal is that because of Vanguard's cost structure, it's very hard for them to play nicely with platforms. And I know that when platforms decide to that they need to raise fees, Vanguard then has to go. As an example, when I was at Ameriprise had their trading platform. It was very difficult for me to buy Vanguard stuff for my clients. And I would have to pay an astronomical fee. I, as the advisor, would have to pay an astronomical fee to help my clients get into Vanguard on that platform, because Vanguard does, they are beholden to one person, which is the investor, and that low fee passive approach. So Ray, I'm guessing, I don't have proof, but I'm guessing that the same thing happened there. TD maybe said, hey, we need a little more money. Vanguard said we can't. TD says, okay, well, guess what? So I'll be interested to read more about that story.
So now I have a question for Ray. What happens? You own these 2 ETFs and you've got a TD Ameritrade account and you can't blast them out?
Did they slide them over to the what did they do, Ray? Did they slide them over to the TD equivalent on those? Because TD has similar passive positions. I'll be curious to see what Ray says there. Mm-hmm. Let's talk a little bit about active investing. And I know that there might be people with us watching this that didn't see when you were on a couple months ago, but you think differently than a lot of the things that we see online. Sometimes people say active investing is dead. It's all passive, to Ray's point, right? What he's talking about with Vanguard. You've got a whole different view.
Yeah, I don't think active investing is dead. There's certainly been a huge shift from active to passive, but I think it's really been more a function of performance and fees than it has been, the concept behind active management. When you underperform for a decade, and most of that underperformance comes from the fees that you're charging in your active product, you're going to lose customers at some point. And I think that's exactly what's been happening here. Our view is that active management will continue to exist. It should continue to exist, but it has to evolve with the times. So the nice idea, the quaint notion of this, really good research analyst or a star portfolio manager being able to read company filings and an annual report and listen to a conference call and build a cash flow model and have some better insight on that company's prospects, those are just days that have gone by. There is so much data out there right now that you have to be listening to and tapping into all these alternative types of data sources and really take advantage of the technology available to make sense of all that data and process it and get some insight from it. If you're the kind of research analyst that just needs to put your head down and build a model, you're going to miss all the trends that are happening in the market. You're going to miss what people are going online and saying about the company, how they're interacting it, what they think of it from a brand perspective, what they think of it from an investment perspective, where they're spending their dollars, real-time transactional data, which exists in huge amounts right now, which can be processed. So if it's any kind of consumer facing company, you can get a sense either by satellite imagery of counting cars in parking lot, by listening to transactional data, by listening to online forums, shows like this. All of what we're doing, even right at this moment, is leaving a digital trail that's ripe for analysis. And if you're not paying attention to it, it's going to be impossible for you to outperform. On the other hand, if you are paying attention to it, there's some really interesting insights that you can get from it. That's where active management is going. It's really going to be a blend of machine and man, or all machine artificial intelligence, to make sense of it.
And it's clear. I mean, hedge funds are already using technology, right? I mean, there's evidence right there. The active management people doing kind of the stuff you're talking about. It's actually being done, but it's not been available to the masses like it is now.
And that's been a few years now. And there's been a big trend at the hedge fund community, even some of the really large, sophisticated pension plans. They're hiring data scientists, 10 to 1 versus traditional investment analysts. And that's because they know that data is out there, but they need to build the systems to be able to manage it, pull it in, and try and make sense of it, recognizing the value of all of the data that were being left behind. And really, that's what we did. Buzz was born out of our hedge fund, right? We've been running our own hedge fund since 2009. I've been in the business since 1998. Buzz started as a research project 4 years ago, and the idea was, this data is available. Processing power is increasing exponentially. The cost of processing is going down at a rapid rate. It's really easy to access it right now. It doesn't have to stay hidden in hedge fund products. We can make this accessible to everyone.
Yeah, it's interesting when you look at where the ball's headed. It just seems to me that with so many people going passive. I think about you're familiar with Franklin Funds, with Franklin Templeton Investments.
Sure.
Sir John Templeton, right, was the guy that always said, if everybody's looking left, I'm the one that looks right. And it sure seems like with everybody going passive, that even creates new opportunities in active land.
Right. Of course it does, because no one's paying attention to the prices they're paying. They're just paying index levels, and they don't even know the stocks that they necessarily own. There's always room for discussion. There's always room for an individual stock to outperform. There's always opportunities for, a little more thought to be put into your portfolio, into your investment process. I think active isn't dead. It's just changing. It's evolving. I just got back, actually. Last week I was in Frankfurt, Germany. And there was a big conference there. It was the Next Gen Alpha conference, and it was purely based on current managers using artificial intelligence, tapping into these resources, presenting how they're actually applying it. But the audience was so interesting. It was advisors, it was mutual fund companies. It was really more of a sort of a seminar conversation than it was a typical conference agenda. It was really people curious about what's possible with artificial intelligence, what's possible with these types of techniques. We hear about it so much, on every newscast, on every time we open a newspaper. It's all about big data or AI, and it's not just with investing, but it's everything. So people are really curious about this. They want to really dig into it and understand what's possible, what's it good at today, what's it not good at today, and is this where the ball is really going? And I want to be forward thinking in my firm and make sure that we're around as active managers in a decade from now. What should we be thinking about? How do we learn about this stuff? So it's not just a North American phenomenon. It's really something that's happening all over the world.
I was going to ask you about that. I was curious about having a Frankfurt in Frankfurt. Did you have a hot dog while you were in Frankfurt?
Pardon me?
Did you have a Frankfurter while you were in Frankfurt?
I didn't have a I know. I had a Wiener Schnitzel. Does that count?
That's close enough. You're almost there. You're close. But actually what I'm really curious about is when it comes to like your index, Jamie, does it stay static? I know it's proprietary, the methodology you use, but is that evolving or is that set it and forget it? Are you guys now running a system that stays static?
So you may have heard this term machine learning, right? And that's sort of one of the hallmarks of artificial intelligence today, or reinforcement learning. And that's the idea that your models should get smarter over time with more experience. This is a great time actually just to give a quick summary of what is artificial intelligence and basically the concept behind it. Now, because we have this great advances in processing power, we can train models really to learn the same way our brains learn, right? So how do we know anything as human beings? It's experience, right? We have experience at things and we can then make decisions based on our experience in uncertain environments. Self-driving cars, perfect example.
Right.
You and I have been driving a car for 25 years. We've got lots of experience. We can go to a new city, get in a car and figure out, what to do, how to drive it without driving into people or buildings or other cars. Now imagine you can train a computer through experience instead of rules, right? So the old artificial intelligence was all rules-based. It was a series of, if this happens and this happens, then do that. And you can imagine literally the billions and billions of if and then statements that you would need to put into a computer to teach it how to drive properly. And it would be unable to make a decision if it came into a situation where it didn't have a point of reference from one of these rules. Now what we're doing and the way artificial intelligence works is by just allowing the computer to watch billions of hours of car driving, it absorbs all that experience. So where we think we're great drivers because we have 20 years of experience, the car's got 1,000,000 years of experience. Really, it's got that equivalent. Of course, it's going to make better decisions. That's AI today. And so what we're doing on the investing landscape is training models. As new data is coming in, it's getting new experience. It's getting more insight into, for example, what we do at Buzz, the way people are talking about stocks, slangs, references, different new stocks coming into the index. It even understands who is talking about it. So Joe, when you're tweeting about a stock, we know how you talk today. We know who your followers are. We know how good you are at predicting stocks, but you change and you evolve over time. We listen to that. We recognize that you're changing and your influence changes over time. All of that gets captured into the model without having to reprogram new lines of hard code. That's the difference. That's the exciting thing about AI today, is that it's learning.
Yeah. So if I used to be great at predicting stock moves and lately I haven't been, you're saying the machine goes, yeah, don't listen to him as much.
Yeah. Or just take note of it, right? So imagine you having that relationship with another person. If that person kept giving you advice, you would maybe note it. You'd know that you had some success in the past, and your weight would that person's weight on your decision-making at the margin will change just a little bit. Now imagine applying that over hundreds of thousands of people, and you really can stay ahead and get the right insight.
I got to tell you, do you see Ray's comment here? Ray, I'm with you. Ray says, I'm old now, so this sounds like science fiction. Hard to wrap my mind around it.
It's so true. It's hard to wrap your mind. You might have heard the term neural network, right? But that's what your brain is. Your brain is a neural network that learns by experience, and it happens so instinctively. you don't know why it's happening. You can't go backwards and re-engineer why, you can recognize what a dog looks like, right? But really, you just know because someone pointed it out to you once and you've seen enough of them that you can put that together. That's what AI is today. That's how image recognition works.
And to Ray's point specifically, Jamie, I think this is what interests me in active invest. I would have no interest in active investing if machine learning weren't around. And my son is in this very field. In fact, I don't know if I told you this, Jamie. He just got hired by Microsoft out of college. My son has a job out of college with Microsoft. Actually, I could have stopped that sentence at my son has a job, and I would have high-fived everybody. My son has a job, but he's in this field, and he talks about how difficult it is to create this machine learning because computers are so literal.
Yeah.
And teaching them the fact that sometimes, probably 90% of the time I'm sarcastic, like teaching a machine sarcasm is like the hardest thing ever.
Right.
Or teaching them, if somebody is supposedly talking positively about a stock, but they're really talking negatively and they're making fun of it, it's very difficult for a machine to get that. And
So it's impossible for a machine to get it if you're doing keyword analysis or rules-based analysis, looking for a specific word in a phrase, it'll never pick that up. Here's why it works in machine learning. It all comes down to the training data that you have to train your AI machine. Okay, this is very important. And this is the difference between the fields of general AI, which is still conceptual, building a robot that can be better than us at everything, versus task-specific AI, which is where we're at today. So an example, again, of task-specific AI would be facial recognition, right? You can train it by giving it millions of pictures of the same person, or not even, just millions of pictures, and labeling those pictures who they are. It can start figuring out with new pictures who belongs to who. If you ask that same AI to listen in to conversations about stocks and tell you what people are saying about stocks, horrible. It won't even know what you're talking about, right? It's specifically trained for image recognition. So what we're doing on the investment side is there is so much online discussion around stocks today, stocks specifically. We're not talking about conversations around restaurant reviews or product reviews, just conversations about stocks, because people talk about stocks very differently. They use that slang, they use those, sarcasm and all that tone. But when they say it around a stock, and more importantly, we can label it, right? As humans, we know if that's positive or negative, even if it's slang, even if it's sarcasm. And so by having enough examples, and when I say enough examples, I'm talking about millions of examples to feed into a neural network to understand the base case for that very task-specific project, it can then apply patterns in what it's observed from those millions of labeled data posts and apply them to new posts that it's reading when people are talking about stocks. It's as simple as that.
Yeah, very simple. Very, very straightforward.
But it's this classic garbage in, garbage out problem, right? Don't take something trained for facial recognition and think you've got a general AI that can listen to stock conversations or drive a car. It's not going to end well, right? So we're still in a very task-specific world when it comes to AI. But when we live in that task-specific world, we get remarkable results.
We're talking
Just
to
your smartphone and all it can do.
Right.
Got a handheld AI machine right there.
It's so funny because I heard a comedian saying, what if you talked to me like in 1975 and you had told, young Joe that someday there'd be a device that I can hold in the palm of my hand and I can ask it almost any secret of the universe, but all we use it for is to watch cat videos. It has this huge capability.
We get some value from Google every now and then.
Just a shout out to my business coach, Mary Lou, says, just so you know, I'm watching. So be on your best behavior, Jamie, because Mary Lou's here.
Yes, sir.
So, yes, we got a hello, Mary Lou. By the way, if you've got a question for Jamie from the Buzz Index, is he on the Stacking Benjamin show? He's our social media correspondent. As you know, he's on the show at least once a month talking about what's going on buzz-wise. His index trades under ticker symbol BUZ and tracks all the things happening in social media. And each month, what happens is the 75 companies with the greatest buzz come into the index, and then other companies go out of the index as the buzz calms down. I want to ask about the fourth quarter, because it sure seems to me, Jamie, that when we get to the fourth quarter, things change a little bit. You get these we're going to have Thanksgiving week. We talk about Black Friday. Seems like there's probably a lot of buzz around retail. You hearing any buzz that you might expect to see retail positive or negative in the fourth quarter?
Well, Amazon, right? People recognize the power of Amazon and what it's doing to the traditional retail landscape in the brick and mortar shops. We've had names like Macy's come in and out of the index. Maybe it'll pop back in if people, are optimistic about the holiday season or spending and those types of things. But by and large, I think that people recognize the challenge for those businesses in the long haul. And Amazon, once again, last week we saw it with their earnings. There's no bar that seems too high that they can't climb over, and investors are still excited about the story. That's, again, not my opinion. That's the view of, the millions of posts that we're reading on how people talk about Amazon. They stay positive, that stock. The sentiment momentum behind it is strong, remains strong.
So that means I'm guessing partly Amazon's the big winner in the Toys R Us blow up.
It sure is. And you know what? We've had Mattel. There's another one that's a holiday name. Mattel came in the index after the stock blew up, right? And traded down to 15. And I think people, again, started thinking maybe Mattel isn't going to be as at risk as Toys R Us because they can sell their toys on Amazon. It's not sort of a retail story. It's a manufacturing story. Yeah, I think people were a little early on that. And we don't get them all right at Buzz, and you can't get them all right because the community just was a little too early on that name. Maybe the holidays will come back. I think it's still in the index at a lower weight right now, but still some challenging times ahead for traditional companies.
Well, it is funny because, as Mary Lou says here in the comments, shop local. And man, I like shopping local. I like getting people quirky gifts. But the average person looks at Amazon Prime, Jamie, and goes, ease of use wins the day.
Yeah, it is local, isn't it? When you can get it delivered to you in a day. I know I just ordered a new iron from Amazon yesterday. And it came today, right? Amazing. Right. So that's tough to compete with.
Pretty soon the drone's going to bring it to your house right now.
That's exactly. I think you get in New York City, you get Amazon delivery in less than 2 hours.
Isn't that amazing? In Texarkana, you get it in less than 24 days. So
I'll tell you what'll be interesting is watch the community's reaction to, as Amazon continues to grow, companies like FedEx and UPS, because Amazon's a significant part of that business. And I think Amazon, like everything else, is just going to internalize all of their distribution and shipping. And what kind of impact will that have on FedEx and UPS? And can Amazon figure out a way to ship products better, faster than those traditional hubs?
And how genius was it of Amazon to make it this sweepstakes for their HQ2, for their second headquarters? I mean, just all the buzz, speaking of buzz, all the buzz around that they just made a circus, which is all great advertising for them.
It's fantastic. And you know what? If it shows you anything, it almost affirms what the community is saying about the stock. Everyone wants to be a part of that story. Every city wants to be in there and put their best foot forward. They recognize the long-term value of having them part of their community, right?
Which is the bad news, because as a guy who makes podcasts, I'll tell you what Amazon worries me. Because one thing that's happened in conferences I've gone to lately is search is going from, typing stuff into Google to asking Alexa, give me a money podcast. And Amazon is going to control which podcast wins the day. And, a little tiny basement-based company like me up against, big giant gorilla that can pay Amazon more money to get that search. Like, the future seems kind of big brother that way.
Yeah, I try and look at, because we're so wrapped into the technology here, I truly try and look at the coin from the other side, in that the risk is Amazon could do that, right? They can decide who they want to be the winner of the podcast, sweepstakes and get up at the top of the list every single time. I'm not sure that they'll do that. I'd like to believe that these companies are still more thoughtful about providing good experiences and good value, and that as consumers, we see through that, right? We know when something's legitimate and not. And I think the way Google changed the game in search is that it wasn't them deciding what the most relevant result would be for whatever search you were doing. It was really community-based, right? Google was the first crowdsourced search engine. That's the way Google works. It's what's most relevant based on other people's searches, because the community will probably make the right decision, and our computers can recognize how people have searched for similar things, what the community likes best, and let's return that, because that's probably the highest value proposition for that search. And then sure, we'll put some ads on the side and we can make some money off that, right? So Google was, Google led the way for Buzz, right? In recognizing the value of crowdsourced data. I would have to believe Amazon's too smart and too sophisticated to, try and trump over the little guy for the big ad spenders. I think there's lots of ways they can monetize their base, but most importantly, providing users good experiences is what's really driven these companies.
We talked earlier about smartphones, and being used for cat videos. I like what Jeff says. He's learned his smartphone works better as a paperweight. So,
I'm a strong supporter of Android-based products, so I'm going to guess he's got an Apple and tell him to come join the dark side with the Google Pixel.
It's a war. And Michael says, back to Amazon, Amazon's brought fear into who he works for, Frito-Lay. I think a lot of companies, it's, you look at what Amazon's done to some of the competition, Jamie, it can be that they're a tough company to compete against. Tough stuff. Let me ask you about this when it comes to the Buzz. By the way, if you've got questions for Jamie about individual stocks, if you've got questions about your asset allocation, we're taking those. We're not just talking technology. We're talking technology right now because I'm consumed by it. And I think it's really fun. But a question for you back on technology. So we've seen talking about Alexa and about Google Home. So you've got those two. Now you have news that Microsoft is really starting to invest more money, I think with Harman Kardon in that area as a partner. Is it too late? Like, is Microsoft too late to that battle, Jamie, do you think? Has there been any buzz around Microsoft?
I missed that. You said their investment into
the same thing as Google Home and Alexa, like Microsoft now with Cortana getting even more involved there and finding partners to build their own speaker system. Is it too late?
Probably, but I think there's an opportunity for them, right? So whether you're going to use Amazon or Google or Facebook or Microsoft, it depends what you're using it for, and it depends how well you want them to know your patterns and your behaviors, right? So you may use your Amazon interface to do all your ordering on Amazon, and that way it's very easy for it to understand when you're probably running out of something that you use all the time and suggest it reorders it for you and those types of things. But if you're sitting at your computer, you might not want to interface with Amazon for regular search queries or other types of things. I think that it all depends on they need to achieve that scale, right? They need to have the data to train their AI with, the relevant data. And if one can prove that it adds value over another, it'll win, right? But someone can always leapfrog over another competitor, but they're not going to do it just by copying that competitor. They have to actually offer something that adds more value. Can Microsoft do it? They've come back on things in the past, certainly in the on the Surface Pro and in the tablet space. Maybe there's a chance here. We'll wait and see.
Well, Microsoft under the newish CEO getting a lot of buzz lately. Have they had enough buzz lately though, and turned that company enough that they've appeared in the Buzz Index? Have you had Microsoft in there?
It sure has, and have a look at that stock chart. It's performed wonderfully, right? So I think that renewed focus on AI and data and cloud and all those words that we hear about that make us a little uncomfortable in our jobs because they're taking over. I think Microsoft did a good job when they changed the leadership of that company and really put a focus on that new effort. It's paying off. Revenues are going up. Stocks trading at all-time highs. Investors like the story. They think it has a chance.
We said the magic word. I'm not going to say the word, but if everybody wants to read that on screen, I forgot we said the word. And so anybody with that device, it's just had that go off. Thanks for that, Brandon. Awesome. I want to ask you about percentages of somebody's portfolio. Let's say that somebody's considering buying the Buzz Index, having you guys take care of looking at the Buzz versus trying to figure it out themselves, which, much simpler way to go, right? What percentage of somebody's portfolio would you say that the Buzz Index belongs as? Tell me on a risk reward, maybe standard deviation or whatever. How aggressive is this?
I think everyone, recognizes that their own unique life circumstances have to really drive how they're allocating stocks, bonds, cash, other things in their portfolio. So I don't think it's appropriate for me to sort of come out with a single percentage and say Buzz should be X. What I would say is, to the extent that you believe in an investment style that is diversified, that is focused on large cap US equities, and that can and has actually over the last year and even this year to date outperformed passive strategies, then Buzz is a great alternative to whatever active strategies you might have. So if you have active mutual funds that are invested in large cap US equities, I would certainly almost guarantee that Buzz is probably a lower cost option and a better return option in that regard. So I would look at your portfolio and say, what am I comfortable with? What kind of long-term exposure do I want to active management? And I think there's a smarter way of getting active management. Buzz is an option there.
We talked about this before. What's interesting to me is that there's this concept called alpha, which a lot of people watching might not know much about, but that's where you're producing returns that are over and above what you get from the index. I put that very poorly, but you guys, it's very quirky. You don't correlate well at all with indexes, which means that in a diversified portfolio, having Buzz, while everything goes yin, you're going to go yang.
Yeah, I think to some extent that's true, and we've seen that in the returns. The Buzz index and the BUZ ETF, it does hold large cap US equities. It is fully invested at all times. So it's a long-term strategy. And you should expect some amount of correlation to the market as a result, right? If the entire market goes up or down, Buzz should, just because it owns stocks, move and have some correlation there. But what we want to find are those stocks where if sentiment is strongest, and this whole concept of the exciting thing now that we can actually harness and measure sentiment right down to the stock level, if you could identify which stocks have the strongest investor perception and momentum behind them, the thesis being that on the downside, those stocks should be a little more insulated because the community really likes the story behind them. They would view that as a better opportunity to buy and a little more support on the downside. And then we'll see the stories play out, and it should do a little better on the market on the upside. So we're looking for a little bit of an asymmetry to our return profile. Asymmetry meaning, can we go up a little bit more than the market on good days and down a little bit less and consistently outperform over time? That's what you should expect with Buzz. But you should also keep those expectations realistic. We are not trying to do something really risky here with the goal of doubling the market or quadrupling the market, right? This isn't a strategy that would be high risk in that regard, where we're looking for a high risk win. And obviously, and some people don't say this all the time, but when you have that optionality, that high risk win potential, you're taking on a lot of risk to do it. What we want to do is deliver people a portfolio of names, and go to the buzzetfs.com website or buzzindexes.com. You can see all the holdings every single day. You will recognize the 75 large cap US equities that we own. These are names that are familiar to you. The difference is, this is how it's active. It's not just owning them by their market cap like the S&P 500. It's owning them in a little bit of a different way, where we can now listen into all of our conversations about stocks and identify those ones with the strongest momentum behind it. So we should be outperforming. I think we outperformed the S&P 500. I'm just looking. What is this? Year to date, we're outperforming it by 4%. Over the last year, it's been 6%. Those are the kind of numbers we want to see. We want to show that we can add value, but we're not taking on a whole lot of extra risk to do it. It's just a smarter way of picking stocks.
We got time for a couple more questions. We got Jamie for a few more minutes. So if you've got a question, I got one here, Gary. I'm going to get back to you for a second. I think that's hilarious, Gary. So we're getting back to that. I want to talk about that, but let's ask Kimberly serious question first. Hey, Kimberly, by the way, how are you? How many companies does the Buzz Index have in it? Is it a set number of companies, or is it flexible?
Great question, Kimberly. So there's 75 companies in the index at all times. The only constraint that we put on that is that they must be a large cap US equity, so a market capitalization of 5 billion or higher, and we won't allow any name in the index to be more than 3%. So that's going back to the diversification that I was talking about before. We really don't want one name to have a huge weight in the index and then drive the returns. We want the sentiment factor to shine through. What does change over time is the list of eligible names that could be included in the index. So this is actually important. There are 7,000 stocks roughly that people are talking about across digital platforms in varying degrees. Once we focus on large cap US equities, we then only focus on those stocks that have the most consistent and wide breadth of natural conversation to them measured over the last year. So think about these as the most discussed stocks. And it's important from a statistical perspective because we want to make sure that our sample that we're seeing, that we're analyzing for sentiment, is actually predictive and representative of the community, the investing community at large. So that list of eligible companies takes you to, I would say about a year and a half ago when we launched, it was about 150 names. And then we took the 75 most positive each month for the index. Now, as conversation continues to grow, that list continues to grow. It's sort of the model learning from new things over time. So now we've got well over 250 companies that meet that criteria of most talked about names. And that just gives us more opportunities to find new names that are poised to outperform, that lead the way in sentiment.
And that's important because, and you explained this to me earlier or before, that this is partly to make sure, it's the biggest names to make sure people don't try to manipulate the buzz, right? I mean,
yeah, we get that question.
Yeah, with a company the size of Mattel, it's hard to manipulate that buzz. Exactly
right. Right. So, people are all aware that there can be bad actors online, right? We still hear about it every day with the US election, right? So, it's very unlikely or very difficult for someone to try and manipulate the sentiment and the tone of the conversation around a company like Disney or GE because it is so widely held and so discussed and so liquid and so actively traded that if they were to try and really post, whether it's positive or negative messages about it, the volume would have to be so great that every algorithm, including ours, would pick that up and notice it very quickly. Those types of bad actors really tend to focus on very small cap, thinly traded, illiquid stocks that a little bit of noise can actually have a big impact on the share price because that's what they're going for. And by focusing on 5 billion and up market cap, there's two things that we accomplish. First, we eliminate really a lot of the risk of those bad actors trying to influence any of the discussion or tone or sentiment around those stocks. And secondly, we make sure that this index is investable. Right. So if it holds these large cap US equities, there's lots of trading volume. It's easy to invest in them. They're very tightly traded with tight spreads. So it really makes it something that's relevant and useful for an everyday investor.
The next question comes to us from Ray. Ray says, I noticed financial services is only about 7%, probably because they're boring and nobody talks about that. Is that a problem for you guys, Jamie?
It's not a problem. It's a great question, Ray. And we've seen financials weight in our index be anywhere from 1% to 10%. And we get this question a lot. Do you do anything on the sector side in the index to either force a minimum number of positions to, sort of maybe represent the sector as they are represented in the market? And if not, why? And we don't. And because we think it's really important that the sentiment exposure of the index is really a byproduct of where sentiment is strongest. And there is you'd be surprised, there's a lot of conversation around financials, but we typically, or at least we've seen in the last year and a half, sectors like consumer and tech and healthcare really lead the way in our index. And is that because people have more experience with those companies, so they're more likely to talk about them? I would have said 3 years ago, yes, but now because people talk about everything in their investment portfolio, that's not necessarily the case. I think people have recognized that those sectors have been leading this bull market higher. It's going to be great to see what happens if the market takes a turn. Do people want, start rotating out of those sectors into defensive sectors, into utilities? We're watching the conversation, but the sentiment around those stocks just doesn't match the sentiment of the other names in our index right now.
I'm so interested to see what happens the last couple of months of this year. And obviously you guys, Jamie, have had another fantastic year for the Buzz Index. So congratulations on that. And we'll see you in the Stacking Benjamin show, not this coming week because we got all our live FinCon episodes, but the week after.
I look forward to being there and love this platform. Happy to be here. And thank you for having me.
I'm glad we finally got it working. That was the interface between Canada and the US was not working that well. We got stopped at the border with our audio, apparently.
Hopefully you heard me, but basically I was trying to be a gracious Canadian and say thanks for having me. Love the plan.
You were good. Thanks a lot. Hey, everybody. Coming up, thanks again to Jamie. And the Buzz Index, you can find that at ticker symbol BUZ. Of course, if you head to stackingbenjamins.com/BUZZ, you'll of course be able to sign up. We talk a lot about the Buzz newsletter here. You can get that. And I love reading about what the new Buzz is. We always get with the allocation allocations are, and actually, Jamie, I'm going to bring you back for a second. You always give us what the allocation changes are, the rebalance, which I think is cool, but also just at random times, and by random I mean on my end, I don't expect it. There's some change, and you'll send out an alert to everybody about some of the change in the buzz. Tell me about that.
Yeah, we like to keep people, you don't have to necessarily wait for the monthly index rebalance to see what's happening in the market. And whether it's a name in buzz or a name that's not even in our index, but if for some reason is, garnering a lot of media attention, people are talking about it, we think it's important just for people to understand the sentiment side of the story. Snap was an example of that after the IPO, where we put out a flash notice saying, probably not the right time to invest. Seems like sentiment is negative. So we like to add a little value. You can always reach us directly. If you have a question about an individual stock or a holding, just send me an email. We've got all the algorithms and all the output. We can always answer those types of questions. So yeah, please go to that, the Buzz Indexes or Stacking Benjamins /BUZZ. Sign up for that newsletter. It's not too frequent, but it certainly can give you some good insight. We very strongly believe in transparency around our process. We believe that a lot of the active managers that don't like to share what their holdings are or how their process works is just a red herring to try and justify a high fee structure. So we want to kill you with transparency. You'll get lots of it on our website. You'll see how it all works, what we hold every single day.
And is this the right email, jamie@buzzindexes.com?
You got it.
Okay, because if not, I just broadcast the wrong one to everybody. And by the way, a couple more things. Shannon, I forgot to say thank you to Shannon for live tweeting this whole thing. If you want more from Stacking Benjamins, it's S Benjamins Cast, and if you want to go back and look at what we talked about here and get some of the hilarity that Shannon brings to our show, as Benjamin's Cast is the place to do that. Also, Shannon told me, because she always has, Jamie, she's always got the crazy holiday. And apparently today is Men Make Dinner Day. Did you know that?
I did not know that. Sounds like I need to get home early.
It sounds like you got some work to do, brother. Right. I didn't know that either. I made dinner yesterday.
Can I order that from Amazon? Can they just deliver dinner? And I'll present it as my own.
Right. Did you see that thing about
my whole family?
Right. Absolutely. Coming up. And then I want to end on this before we finally say goodbye. Was Gary said he asked Siri to play a money podcast where I don't learn anything. Of course, that's the Stacking Benjamin show. And it gave him Dave Ramsey. What's up with Dave Ramsey stealing our thunder here with Siri? So we got to teach Siri. How do we get in and do that?
Google. Let's ask Google. I wonder what it says.
Of course. All right. Thanks, everybody. Thanks, Jamie, for hanging out with us again. And let me tell you one more time, just a few things going on the show. Monday, we've got, let me put her book up here. Emma Johnson is fantastic. And she's got this new book out, The Kick-Ass Single Mom. She's going to talk to us about how to juggle family and a career and your money all at the same time. So even if you're a kick-ass married dad, Emma's bringing it on Monday. Then on Wednesday, we've got our live show. Susan was there. And I don't know if Susan's still here with us, but Susan, there's Susan. Susan has those eyes, those just Susan sultry eyes. Automatic Millionaire, David Bach. He joined us live from Dallas, Texas. So David Bach's on the show on Wednesday. Special guest on we have a special show on Sunday. We're going to play another show, introduce you to the Money Tree. I know people have told me they're looking for other cool shows. I contribute to the show called the Money Tree Investing Podcast, and Susie Orman was the guest recently over there. So whether you have a love relationship with Susie or a hate relationship with Susie or somewhere in between, we're going to put that in the Stacking Benjamins feed on Sunday. So you'll get that. All right, everybody, go stack some Benjamins. We'll see you soon. Bye-bye.